What's going on? It's Tuesday night at 6 o'clock here, and we're going to talk about all things real estate, theme parks, and life in Orlando. Welcome. I'm Ken Posick. This is my channel. If you haven't subscribed already, if you're stumbling upon this, wondering what's going on with interest rates, what's going on with living in Orlando, that's what we talk about over on our channel today. This is all about you guys, though. We answer a lot of your questions down below, so make sure you check in. First up, where you're watching from. That's kind of what we started off every week with, because I like to see we get people from the Netherlands, we get people from California, just all over the beautiful planet that we live on. And so we're going to dive in today. I've got a guest that I'm going to bring on today. We're talking about mortgages and that sort of thing. But let's start off talking with you guys. What's going on, Nima from Virginia? Good to see you. Shay from Washington. We got Beth from Maine. What's going on? Chris from Miami. We got B from Virginia. A lot of Virginia people. That's very cool. If y'all want to come on down, I know Virginia's beautiful, but so is Florida. Star from Winter Garden, good to see you. Jeremy, California, but moving in December to Orlando. That's exciting. Very, very cool. We've got Annette in suburban Chicago. Just a bunch of people checking in. I appreciate you guys. Eli from West Florida. I love it. Well, very cool. Well, without further ado, I'm going to bring on one of my favorite lenders in all of Central Florida, Handsome Greg. That's what we like to call him. Good to see you, man.
I'm glad that nickname's still sticking. I'll keep it rolling as long as I can. So.
Yeah, right on, man. Good to see you. Good to see you, man.
You too,
so it's been so Greg, certified mortgage planners, and my team and I, we use you a ton. So we know our in and out. I know your business well, and that's why you're on here today. But what's going on with interest rates, man? This is driving me crazy.
Yeah, dude, it's a little weird right now because we're kind of in like a crazy volatile time, right? Like the rates have gone up really fast. And one thing that I've kind of always said in, the 5+ years I've been in this business is like, it really doesn't matter where the rate is, just as long as it stabilizes. And like, as soon as people got used to 5% rates, they went to 6%. As soon as they went to 6, now they went to, and people got used to that, went to 6.5. So hopefully we're starting to get some stability. I will say the last like 3 weeks or so have been a little bit better, that we've kind of hovered in this 6, maybe 6.5%. But, people are saying it could potentially even go higher. So, we're just waiting for what that ceiling is. Eventually, we're going to hit a ceiling. And once that happens, then hopefully we'll have some stability for some time. But the biggest thing is inflation, Ken. That's a lot of people are talking about that. And that's the big thing, that the Fed's trying to increase those short-term rates to combat inflation. And in doing so, it's caused mortgage rates to go up as well.
All right, so let's talk right about that. So I think that it does make sense to me. I do this all day, every day, talking about inflation and rates and the short term versus long term. But when people hear, okay, interest rates are going up another 0.75%, they're already at 7. That means they're going to 8, and I can't afford a house. Can you bring some levity to that conversation? I mean, that's not exactly the case, right?
It's not exactly the case. They are correlated. They're not directly guaranteed. Like, just because if you were quoted, say, today at 6.5% and the Fed increases the rate by 0.75%, that doesn't mean that you go from 6.5 to 7.25 immediately. It doesn't mean your rate's going up like that. It actually is hopefully in the longer term going to combat those mortgage rates and bring them back down, because inflation is what's so high. And that's basically just a massive influx of money. Everyone knows the government printed a bunch of money, so got all that money out into the marketplace, which helped us through the pandemic when we were, in a lot of economic uncertainty. Now, because the cost of goods and services have gotten so high, and there's so much liquidity, money flowed into the market, they want to get that money out of the market. So they're actually trying to contract the economy a little bit, just because it got so out of control. And in doing so, how do you convince people not to transact? You increase interest rates. And that's not just mortgages. That's all things. That's, in exports, imports, all sorts of business, like the global supply chain. They want to slow that down. And the way that you do that is by increasing interest rates. So the Fed has actually said, Jerome Powell saying, we want to cool down the housing market a little bit, right? Like 2020 and 2021 was insane for appreciation. And we don't want to go into a depreciationary, or whatever that word is, like a place where homes are depreciating in value, but they do want to cool it down a little bit. And so that's the way that they do that, is through increasing the interest rates, for sure.
I saw this interesting, this guy right here. So, let's kind of make it to where, there we go. So the Fed's fight against inflation could cost US 1.2 million jobs. And a big piece of this is interesting to me, because if you look at the last recession, we lost something like 8 to 9 million jobs. So when people talk about, oh, the market's falling apart, you've got the job market's going to fall apart, everything's going to fall apart. That's not exactly the case. They're just trying to pull it back a little bit. Like we had runaway inflation, runaway real estate prices. prices and all that kind of stuff. And today we're actually going to dive in. And if you're watching this on replay, I'll put it in the show notes, kind of right where we're talking about it. But right where we're going as a real estate market, how have 7% interest rates affected the Orlando market? We're definitely going to dive into there now. But I mean, so let's talk about how other changes have been different for the mortgage market. So your refinances are essentially gone, right?
Right. Pretty much dried up. Nobody's obviously rate and term refining because we just hit like a 22-year high in mortgages. So unless you still have your mortgage from 1997, it's more than likely you have a lower rate already.
That's right.
So there's no reason to get a lower, or there's no ability to get a lower rate. The only thing that you would have someone refinance for is like a cash out if they were looking to consolidate debt or something. But I tell people all the time, like, you have a 3% rate right now. You don't want to go to 6.5 or 7 just to pay off, a small credit card balance. Focus on, paying that off in a separate, way with a different budgeting path. But the refinances are pretty much gone, man. Yeah.
Let's check in with a couple more people. We've got off to Disney. It's 11 p.m. in the UK. Sorry for the late one over there, but thanks for checking out. You're probably like in bed checking out Ken and Greg. That's okay. I like it.
Yeah, awesome.
Chad from Lake Nona. What's going on? We got Pixie Dust from Las Vegas. A lot of cool people hanging out with us tonight, man.
That's my place, Vegas.
Vegas, yes, right on. So here's another thing that's really driving, I think, a lot of the inflation talk, right? So if you have low cost for money, right? So we equate that on this channel as real estate mostly, but think about it from a business owner's perspective. If money is cheap, if I'm going to Chase or I'm going to some big bank and I'm a small business owner, I'm like, hey, I can go get all this money for really, really cheap and deploy that into the market. Now, all of a sudden, if the money's more expensive and I can't essentially make any money by borrowing it anymore and going to deploy that in the market, that's going to slow the economy down as well, right? Is that exactly like lockstep with what we're talking about with interest rates?
It's exactly the same thing. Yeah, it's the same concept. And that's why Jerome Powell likened the jobs that potentially are going to be lost in this interest rate increase to also the cooling down of the housing market. They're increasing interest rates, which I've talked a little bit on my Instagram about like affordability, and we'll talk about, obviously you'll tell us a little bit more, Ken, about how the real estate market has kind of transitioned through the interest rate increase, but we haven't seen the drastic decrease in home prices. Like literally, I just saw a statistic the other day that said a house that you would have bought in 2020 at 2.6% interest rate that was $600,000 would have the same monthly payment as a $400,000 house, $200,000 less at the 6.2% interest rate. So we obviously haven't seen $600,000 houses worth 400 now, which, that fact that affordability has decreased for buyers, but the market has still stayed pretty consistent. And even, I think you've said maybe slightly appreciated in average sales price. I mean, that shows strength in the real estate market,
Yeah. Well,
here's transactions, but strength.
Oh, yeah. I mean, so here's the thing. So in overall, transactions are starting to slow. So when you guys look online or you see anywhere on social media, there's plenty of people that are saying the housing market is pulled back 25%. You automatically, most people equate that to sales price has fallen 25%, but that's just not the case. The transactions, the number of homes buying and selling right now is down 20 to 25%, depending. But if you look here, so this is interesting. This actually comes from our Orlando Realtor board, and they look at all of the different counties that the Orlando board covers. And so you got single family existing homes. This is for October 2nd. You actually had single family homes increased to 749 new houses listed during the week. But the median price for single family home increased to $415, a change of 2.5% up.
Yeah.
That's insane. So and then here's I think some other really good stats. The number of single family home foreclosure transactions decreased to 1 last week. So we're not seeing some massive rush of foreclosures. And then the single family inventory decreased by 66. So we're seeing lesser amount of homes on the market. Pricing still kind of creeping up along with interest rates. It's kind of an interesting time right now. So that's my next question for you. If somebody is in the point where they're like, their kids are off to college, or maybe they want to retire, they move to Orlando, maybe they want to upsize or downsize. What are some more affordable ways that people can go out and buy a house instead of just paying the 7%?
Right. Yeah, Ken, as soon as the rates went up, lenders immediately started thinking, what can we do? Now, the big thing that we wanted to stay away from is what happened in 2005, 6, 7, when, values were appreciating really fast and they came up with these crazy 110% financing products and no income and all this stuff. We're not getting that crazy as far as like trying to help people get into a home, but we are creating some products that there's really a lot of potential for people to save, at least in the short term. So one of those is adjustable rate mortgages. So that can be, you know, a 5-1 ARM, 7-1, or 10-1 are the most common, which means 5-1 means the first 5 years are fixed. And then 1 means once a year, every year thereafter, it would change on you. The 10-1 is awesome. I mean, most people end up buying or selling real estate every 5 to 7 years, max 10 years. The likelihood that you're going to be in the same mortgage, whether that's the same home if you haven't sold or that you haven't refinanced within those 10 years, is extremely, extremely low. So you get that fixed rate for 10 years. Who cares about year 11 through 30? You're going to be in a different home or a different mortgage by that time, but you get a little bit of a discount on your rate in those first 10 years by taking that product.
And so a few things with this, like I think that initially I always get like, when people think adjustable rate, they automatically are like, whoa, that's like subprime mortgage. That's what we saw in 07, 06, 05, which caused the last recession. How is that different than these 5-1 ARMs or 10-1 ARMs?
So the difference now is that they still have to qualify you on what that max rate could be. And there are caps. So there's lifetime caps on what these rates can go to. I had a lot of people that when the rates first started going up, we were utilizing these 10-1 products. And they're like, okay, great. I can get, 4.5%, 5%. This was a few months ago. I can get that now. But what if rates go to 18% like they did in 1980 or whatever? Well, you're capped at, say, the lifetime cap is a 5% increase. So say you're at 4.5 now, the worst it could ever go to is 9.5, not 18%. So there still are caps on these, and it's not teaser rates. What it used to be before was teaser rates where they would qualify you on the lower rate, then it would adjust. You had interest only a lot of times, and then it would go to full PITI. So people were like, oh, the monthly payment's really low because they're paying interest only. And then it went to like a full amortization loan. The payments would jump $800, $900, $1,000 a month. Now, if your rate increases, we're talking, say your payment's $1,500, maybe if you get to year 6 after an adjustable, your payment's $1,600, $1,700. Can still increase on you for sure, but at least you're saving that money up front. Right now, if you would take the 30-year fix, you'd be in a higher rate anyway. That's what I tell people all the time. I'm like, if you take the adjustable, you at least save the money in the interim. If the rate increases, you were going to spend that money in year 1 through 5 anyway. So who cares that you have to spend it then on a little bit higher rate? But if you sell the house in year 3, year 4, you got the lower rate for those first 3 to 4 years. You got that benefit.
Yeah, I think that's the big difference. I remember, so I was in the market. I got into real estate in like 2003. And so I saw the run up, and then I saw the calls from, thankfully they weren't my clients at the time, but like, people were calling me like, hey, I got stuck with this mortgage where it was a 1-year interest only balloon. I financed 105% of the purchase price so that I could get a check at closing. Now the market's dropped 30% and I can't afford to pay the commission. I can't pay transfer tax. I'm upside down on my house. What do I do? I can't afford this house, right? And so I think that it's a big difference between that scenario and what we're talking about now, which is essentially you have to get qualified for the higher rate, make sure that you can afford it. If you have to pay 7%, you can still afford it, but getting the 5-1 or the 10-1 allows you to save a point or two off of the interest rate. Is that kind of the difference at like interest rates right now?
100%, man. And that's the thing is like back then they were doing those balloons and the high financing. Like these are still adjustable and it's a full AM. It's still a 30-year full AM. So you're never going to have a balloon where you have to stroke a check or refinance again. You can still hold the loan for 30 years if you still are holding it after that adjustable period. But it just allows someone in the short term to have some relief from the increase in interest rates. And that also leads me to the second point on was the 2-1 buy down, which it started to kind of build more steam in the marketplace.
I'm hearing a lot of builders mention this and a lot of other lenders. So talk to us about it.
2-1 buy down. 2-1 buy down is awesome. So basically what it does is you have a 30-year fixed rate, say it's 6% today. If you're locked in at 6%, in year 1, your rate's only going to be 4%. In year 2, it's going to be 5%. And then in year 3 through 30, it's 6%, the standard that it was originally going to be. So the point of that is we're still qualifying you on the 6%. We know that you can comfortably pay that. But in a time right now where the market has shifted a little bit and sellers are more willing to help with things, if the seller will pay for that 2-1 buy down, it saves you a couple $100 a month in those first 2 years. I mean, I've priced some out where, people are going from a $3,000 a month mortgage to $2,400. I mean, that's game changing.
That's a massive change. Yeah,
Yeah.
if we can get people back into the fours, like fours is a very affordable kind of thing, even with
Right.
even with pricing not pulling back. And I want to get to a couple questions here
Yeah.
in a minute. So make sure you guys drop your questions down below for Greg and I. Again, real estate related, theme parks, living in Orlando, any of that good stuff, drop it down below. But specifically saying on mortgage rates, so what does that cost? So you mentioned if the seller's willing to kick in some funds, what is something like that just ballpark cost if someone's purchasing a house?
Yeah. So what it really is if you really break it down, it's like third grade level math. All you do is take the difference in the 6% and the 4%, that 2% difference in the first 12 months. So say it's $500 a month, you times that by 12 months that you're having the savings. So that's $6,000. And then let's say in year two, the savings are $250 a month. 250 times 12 is 3,000. So 6,000 in the first year, 3,000 in savings the second year. That's $9,000 total. That's what the seller would need to contribute. What it really is the seller creating a savings account for that buyer to cover it. So it's like people think, oh, it's adjustable, it's going to move. No, your 30-year fixed 6%, but the seller is contributing towards a portion of your mortgage payment in year one and year two to help alleviate some of the pressure of the high rates. The hope is that by the end of year two, rates are back down to, like you said, I mean, the comfortable number that we're hoping for at some point in 2023 is 4.5%. That's where rates really should be at. Not the crazy low 2% like COVID rates were, not the 6-7% we're seeing now. 4.5%, that is where we want to be. So if we can, get you from 6.5 now to 4.5, 5.5 in year two, and then by the time it's going to go back to 6.5 refi you, that's what ideally it's for. The other reason, real quick, Ken, that I want to point out in the 2-1 buy down that I love about it is it's created like an escrow account where, let's say after 8 months, like say you buy right now and all of a sudden in 8 months interest rates come way down, or something happens and you have to move to California and you got to sell your house in Florida. That money that's in that escrow account, you get that money back prorated. So if you've only spent out of the 9,000 that the seller set aside for you, you've only spent 4, you get the 5 back. On an actual buy down, you don't get that money back. Like if you're just buying down the 30-year fixed rate from 6.5 to 5.5, and you spend 10 grand, you sell the house 6 months later, that 10 grand is gone. You don't get that back. But in the 2-1 buy down, you do get that money back. So that is the one thing that I do love about this product.
Amazing. Awesome. Let's check in with some people that are watching. We got Liz, who's on the team. Good to see you, Liz. I appreciate you. We've got I got a bunch of other people here. Let's see. Andrew's from Philly, moving to Lake Nona in December. Thanks to Kristen. Kristen's amazing agent on my team. I've got some amazing people here checking in as well. Here's a good one though. Hey, howdy, hey, you survived the first hurricane. We're going to talk a little bit about hurricane news in just a minute. But let's talk about Nicholas. He's got a good thing here. So owning versus renting in the short term. High prices, high interest rates, and the desire to keep cash on hand as a growing recession fear. I see argument for tabling homeownership for a year or two. Agree? So I've got my answer. I want to hear yours.
Okay. Yeah, I'll go first. Let me throw me out the little foot. So Ken, I always say it's a case-by-case basis, man. So Nicholas, it really depends on your current living situation. If you're in a 3-bedroom house where you have enough space, but you also have 2 roommates, so you're only paying a couple $100s a month on a lease as opposed to the full lease amount, and you have a family and you want more stability, then yeah, there's nothing wrong with renting. I have friends right now that are still renting that have really good deals with their landlords. They've been there for a few years. And I'm like, there's no rush to get into home ownership. But I've also talked to people that are like, hey, now my landlord wants to sell. I've been here for 6 years. The landlord wants to cash out because they're worried, what if values keep going down? Well, now you lost the stability. You thought you had stability because you had, the same landlord, you had a good agreement for 6 years. Now all of a sudden you got to up and move and find somewhere else to live. So with home ownership, nobody's going to say, hey, I'm selling your house next month. You got to get out. So there's more stability in home ownership. Also, like if the rent's going to go up on, a lot of people are in apartments and stuff like downtown Orlando, I'm hearing rents are going up like 20-30% on renewal. It's like, yeah, if your rent's going to get jacked up every single year, your mortgage rate's going to be fixed. So, it's just it's a case-by-case basis, and there's positives and negatives to both sides. But, that's what I think home ownership is about. It's about stability. It's about having a fixed rate. It's about investing in your future. You're building equity. Renting is for someone that just wants more convenience and might, doesn't mind having a few roommates and having cheap overhead. There's nothing wrong with that either.
I think that's huge right there. Right? What you said, I love it all. I think that home ownership is not for everybody. And buying a house today is not for everybody. But circumstantially, if it is for you, for one of many, many reasons, then it does make more sense to buy now than rent. And so I tell folks this all the time, like 35% of people that live in Orlando rent, which means 65% own, and it is what it is. Speaking of and so you gotta know yourself and know your situation. But speaking of rentals, this is an interesting story that you and I were talking about before we went on here. So first phase of DR Horton, and this is from the Growth Spotter, first phase of DR Horton's Avion Point, which is a BTR community. BTR stands for Build to Rent. Sells to nation's largest multifamily operator. And so this is an interesting one because you've got 56 homes, single family homes, and 118 townhomes being built by the nation's largest home builder, DR Horton, and it was sold to Greystar. And this is interesting because for the longest time, we were having issues with finding inventory, and all of these, Wall Street REITs and just people coming in, these institutional investors were coming in and buying out neighborhoods, putting cash offers on homes, and it was cutting out the little guy, which is really part of the reason why we have such high interest rates and such high home prices right now.
Yeah.
But have you dealt with any of these build to rent folks yet?
Not typically on the residential side. That I think a lot of those are like commercial projects where, like you said, you have like venture capital firms and hedge funds and stuff all getting involved in this. And like, what does that say about real estate? It says that it's a good investment, right? When these big funds that have hundreds of billions of dollars are choosing to invest in real estate, that tells you that if you're someone like Nicholas was just there on the sideline, like not really sure about it, it's like, well, if these big companies are getting into it, then it's obviously got to be a good long-term investment. So personally, I haven't dealt with, what the financing looks like for those things and heard a lot about them, but obviously it's starting to pop up more. I mean, it seems like it's the next stage in like what Zillow tried to do in Open Door. We saw how that worked out for those companies. So, I mean, who knows? I know that, a lot of people eventually want to own their own homes. So I don't know how long they're going to last with those build to rent. I mean, maybe they'll eventually open renters up to purchasing down the road like a rent to own thing, but I don't know. It seems dicey.
Yeah, I don't know if you see this OfferPad. So we know Zillow Offers, they went out of business. You have OfferPad, right. Their stock is under $1. And from what I hear, if this goes on for another 30 days, or if it's 30 days under $1, they get delisted. There's a lot of these big companies out there trying to make it work. These were the ones that were coming in and saying, I'll give you a cash offer on your house, over asking. And they were hoping to either rent it out or sit on it for 6 months as the market went up and then resell it and make the margin. And then a lot of these guys got caught red-handed. Like it wasn't working, So it is interesting. I do think you're right though. The Wall Street money investing in real estate, they're buying up entire neighborhoods, which is insane. I don't think this is good though. I personally, I think that I look at, taking inventory out of the market where we already had struggling inventory is not like going to help anybody. To me, it's like the more opportunity you have for more listings, the more affordable housing becomes and gets people out of renting and into actual home ownership.
Right. I got a goal.
Yeah, that's the goal in my opinion. When I say like home ownership isn't for everybody, I think everybody should own a home. But it depends on where you're at in life, right? The stage of life you're in, the season of life you're in may not be for you immediately, but I think that it should be on everybody's to-do list.
For sure.
All right. So Mr. Sean, what's up, buddy? Hey, listen, Sean, I got like 6 runs set up between now and February. I hope I see you at one of those Run Disney ones. So he came up to me, he's working with somebody on our team. And I was like he came up, it was like, hey, we're running the same race or whatever. So hope to see you out at Run Disney. But he says, hey, I'm up for renewal soon for my apartment in Orlando. I started noticing incentives for leases. Hopefully this means apartment prices correct or stay flat. I did see that there was quite more inventory on the lease space. There's more and more people getting deals on the lease side for apartments. That being said, I think what happened over on the coast is going to cause Orlando leases to start getting snapped up. So TBD on this, but I look at how much devastation there was over on the coast. We saw Airbnbs fill up overnight. We saw a lot of rentals start kind of getting popped up. Are you seeing that? I know you have some friends down in like Fort Myers and that whole area. Was everybody okay?
Yeah, I haven't seen a ton of that yet. Definitely the Airbnb stuff, and we've had some clients recently that are like moving from out of state and stuff. And they're like, oh my goodness, like we thought we could just grab an Airbnb or a hotel for the weekend, but they're booked up. So in definitely the immediate short term after Hurricane Ian here that passed through, like that there's a lot of places that are, overflowed with people that have been displaced. Yep. But yeah, I'm not sure about the rental market. I mean, that's interesting. I think, it always just depends. And that's why I tell people like, I was talking to someone yesterday that was going to get kicked out of their house December 1st because the landlord wanted to sell. And they were like, as far as renting versus buying, like what is, better for me right now? And I'm like, well, we have to look at all your financials and see like, if you want more stability, buying's better. But, if you're okay with renting and you had a good relationship and good experience with that, like that's okay too. But he's like, well, what can I find cheaper? I'm like, it just is a case by case. You might be able to find a house that's been listed for a little while that might need some work that you can work on getting a deal on. But somebody else might be renting a place or looking to get a tenant in quick and you get lucky. But that's just a case by case basis. The overall data shows that like rents are increasing still, obviously. So yes, there might be an incentive for a place that just had a bunch of people move out, but in general, it seems like they're going up.
Agreed. Brooke says, Greg, can you tell us about any programs or benefits for veterans, disabled vets, and healthcare educators? I know there's a Heroes program, but what do you know about that?
Yeah, so the Hometown Heroes is the state-funded program. They put like $100 million into this. It's a grant program, so it allows for someone to get basically like a second loan for the down payment assistance. Now, you don't have to pay interest on it, but it does sit there on the mortgage. So say you buy a house for $500,000, you get a $25,000 grant. So that covers the down payment 5%, and then your loan is $475. You're only paying the interest and the mortgage of $475. But if you ever go to refinance or sell that house, you have to pay off whatever the balance is remaining on that $475 plus that $25. It just sits there as like a zero interest second loan. So it helps a lot of people that, can't afford to get a down payment. But if you're a veteran, you already have VA loans that have 100% financing. So usually that's a better option.
Yeah,
if you're a healthcare worker or educator, the Hometown Heroes is a great program though for down payment assistance.
Yeah, agreed. Jan says, great explanation on the 2-1 buy down. Thanks.
Oh, thank you, Jan.
All right, we got a bunch of other folks here. Let's see. The Conway question. So, Ken, what do I think about the Conway area? Does it look like the area is growing? Is it a value area due to future expansion and buildup? I think so. I mean, the cool thing about the Conway area is you've got all the lakes over there. Joseph on my team lives on the lake over on Lake Conway, and he just absolutely loves it and always is telling me about all the new stuff coming to the area. So I think everything from like the packing district over to the Conway area, you've got all of these new developments going on. The cool thing about Conway area is that it's already kind of built out. They're not making any more land over there. And so as you buy something in there, I think it's a good thing for the future investment, especially if you have something special like canal front, lakefront, any of that stuff over there. But it's a cool area for sure.
Absolutely.
Yeah, if you don't mind, California Dreaming, you're right. Smash the like button. It helps push the video out, lets YouTube know that people are actually watching. That means a lot. B. Emma says, Westhaven's website says new phase coming soon. Do I know when they're going to start? When they start up. So they're telling me November, December, they're going to start taking reservations and then start building again January, February. And so you're looking at kind of the end of 23. This is a Toll Brothers neighborhood over in Horizon West off of New Hartsog Road, if you've seen that area. And so they had some slowdown with the development in that area. And now from what I'm getting told by salespeople over there, they're going to kick back up sales again in November, December. That whole Avalon strip over there is just going to be blowing up. Cafe Con Casas. So lots of people selling and moving back up north. With the market changing, does that mean there's greater opportunities for buyers? So I'm not meeting a lot of people that are moving up north, to be quite honest with you. I'm still seeing a lot of people moving here. But in general, because of the market slowdown, in general, you're able to get more opportunities. Like builders have incentives like crazy. They're like, hey, we were working our butts off to finally create inventory. Now we have inventory and we need to get rid of it. So builder inventory is amazing. If you don't want to wait for a house to get built on resale, you're getting a lot more opportunities out there for sellers to do a 2-1 buy down or to do some closing cost credits for you. If you'd rather keep some money in the bank, have the seller help you out with some closing costs. And so depending on what price point you're in, will determine how much of a kind of opportunity you have there. But this is interesting, Greg. I think you'll find it interesting anyways. So this is kind of like the overall single family market from and it breaks it down from like 250, 350, all the way up to 1 million. And so you look at like average days on market or months of inventory. This is going to kind of tell you how strong each price bracket is and how much more leverage you might have in these price brackets. You could see kind of like anything, just to give you guys a little econ lesson for real estate. 1 to 3 months of inventory is a seller's market. They're typically going to get 99% plus from the majority of it. 3 months to 6 months, that's kind of a balanced market. That's like, hey, kind of where we're at almost right now, where there's really no winner in the market. It's just a flat market, which is, I think, good. Anything more than 6 months is a strong buyer's market. You come in and you kind of like, call your shot. So they're saying that basically right now, months of inventory for all homes, all real estate for single family homes is 2.3%. And then you've got under 250. It's still a very hot seller's market. 1.3 market, 1.3, 250 to 300, under 2 months, really 2 months. But then once you start getting over 400, you start seeing it ticking towards that balanced market, right? So 2 months, 3 months, and then over $1 million, you are right in that balanced market, that balanced supply, to where you're able to come in and typically get a little bit more off the asking price. So what are you seeing out there with your buyers? You work all price points, you work first-time home buyers, you work luxury. What are you seeing out there?
Well, I was going to ask you, Ken. I mean, those numbers still kind of indicate on the seller's market kind of side of things. But do you think that just because of how crazy 2020 and 2021 was, that like psychologically, like sellers are like freaking out after their house has been on the market for 2 weeks, right? Like they thought they should be able to list it and sell it in a day, and that's just not happening anymore.
Yeah, I think that's big. It's really like the whole mindset piece, I think, that's changed so much. And so for us as agents, we're having to be like more educators. And I mean, we're always educators, but sitting down with somebody and explaining to them what's going on in the market, not listening to the news, like the sky isn't falling and you're also not getting 100,000 over asking. Like we're right in the middle.
Somewhere in there.
Yeah, somewhere in there, right? So that's kind of a huge difference.
Yeah, I would say it's definitely taken people a little bit longer, I would say, to find a house now, is what I feel like I've been seeing, which is a little bit kind of backwards, but I guess it's more so because people are more diligent about finding those opportunities. I've had a lot of people come to me saying like, I was looking to buy a year ago, but I couldn't pay $25,000 over appraised value. I actually need some help with closing costs. So they're just taking more of their time, and that leads to like what we were talking about with less number of transactions. It doesn't mean that the sky is falling and real estate values are going down by 20%. It means that all the people that were like the quick emotional act now buyers, they already bought in 2020 and 2021. The people that are buying now are the ones that are a little bit more methodical. They're more diligent. They're looking for the right deal. They're looking for the particular house that they really want. They're not going to make sacrifices. If they want a pool home, they're buying a pool home. You know what I mean? So that's more the buyer that I feel like I've been working with recently, which isn't necessarily a bad thing. It's just a little bit different than what it was, a short time ago.
Agreed. Yeah. And so speaking of short time ago, so Orlando Cruz asks, great name for living in Orlando if you live here. Won't it take a few months to fully realize the effects of interest rates on those inventory numbers? Yes and no. I mean, so here's what I show off every time we go live. We talk about the market watch. And again, this is the 7-day rolling average. This is about as quickly and current as you're going to get in the real estate market. This is the 5-county area of Orange, Osceola, Lake, Seminole, and Osceola, Central Florida. So anyways, you've got 885 new listings. 1,100 of them of our active listings had a price decrease. But here's the really important one. If you want to look at what's actually happening today for inventory numbers, is this pending number. Now, this pending number has been right around the same number of new listings. And so essentially like, hey, for every new listing that pops up, one sells. For your new listing pop up, one sells. As long as we stay in that kind of motion, the market's going to stay pretty like where it's at. If you all of a sudden start seeing a massive balloon in the top number there, listings all of a sudden go to 1,500, and then you have 400 pendings. Well, then now we're in a world of hurt where we start seeing houses sit on the market forever, prices start dropping like crazy. And so that's why I bring this up all the time. Now you will notice, I mean, for 5 weeks straight, we had the pending number that was actually greater than the listing. Now, post Ian here, week later, 885 and 863. It's kind of negligible, 12 different, but that is something to pay attention to. Like this is the first week in the 5-6 weeks that we've been paying attention that it's starting to see a little bit more listings. So does that become a trend? That's what I'm here for. So make sure you subscribe if you haven't. Oh, man. All right. So let's ask. So Big B, so do you see any buyers pay cash than they do a reverse mortgage? I just don't like the idea of having 700 grand sitting in home equity. listen, I don't like having $700,000 sitting in cash, but I also like understand your thought pattern. But do you have an answer to this, Greg?
Yeah, I mean, it just so the point of a reverse mortgage usually is when somebody doesn't necessarily have the assets to live within the means to take care of themselves, but they have a bunch of home equity. So if you already have the cash, then you wouldn't really want to buy cash just to take out a reverse mortgage. You would probably either just do a forward mortgage and pay it down and keep that 700,000 with like a financial advisor or something like that, where you're gaining interest, or you would just buy it cash and leave it there. But there is a cost to taking on a reverse mortgage, and usually that is the opposite. Is somebody's been in a house for 30 years, they paid it down, they now own it free and clear, but they have no other money in their name. They're just getting a social security check. They need some more money to live off of. That's what's the purpose of reverse mortgage is usually typically for.
Yep, agreed. So what price point is selling the most right now? I would say still, if you're looking, so if we go back to our little thing over here, so where's the most amount of inventory increase / where's the most amount of home selling is kind of like right in that 300 to 400 spot. Would you agree? The average
Absolutely.
midpoint?
Yeah, that's still the bread and butter for sure.
Yeah. That's where, I mean, if you think about average payments, I mean, those people were probably looking at 500-600 at first, right? And then now interest rates have brought them down to where they're looking in the fours, right? Maybe they have to drive a little bit farther. Maybe they have to do the 2-1 buy down. You just never know. All right. So we're going to wrap up in about 5 more minutes. So if you guys do have questions, make sure you drop them down below and we will get as many of them we can in. But this is an interesting one. So Made in America is back, leaving U.S. factories scrambling to find workers. Now, this has been a problem, right? We've had a very, very strong job market, which is part of the reason why business owners are also struggling, right? Like if you've got a really, really tight job market, you're having to pay people more to get them to stay or pay people more to get them to come work for you, right? And so if money's all of a sudden more expensive, then people are going to stop hiring, which is going to cause job loss, which is going to cause unemployment to rise, which is what they want, which is so crazy to think that like we have got such a strong job market that they're like, you know what, we need to blow this all up.
I know, it's crazy. Like the logic is just like, wait, what? But they're thinking longer term. So
yeah, longer term. Yeah. So this is interesting though, because I was going back and I think a lot of us were looking at, hoping that the jobs numbers was actually going to be worse, but the job market got better. It showed U.S. manufacturers added another 22,000 workers in September, increasing employment in the sector to nearly 500,000 over the course of the last 12 months. Nearly 13 million workers employed in the U.S. factories, which is the largest since the Great Recession, this is actually amazing. You and I are on the younger side, but I know we were both kind of in the business at the time. And I remember in the last recession, people were like, screw this. I'm going to college. I'm going to go rack up some college debt. They're going to pay me to go to school. I'm not working in a factory. I'm not going on dirty jobs. I'm not going to do all this stuff, right? Now what we're seeing is people pivot towards factory jobs and labor kind of jobs and skilled trades. And
skilled trade jobs, exactly.
Man, I was talking to my electrician today and he was like telling me how much money that they're bringing in. And, people at base salary, they're like, hey, I got to be an apprentice. I'm finally a licensed electrician and they're making bank. And so
it's a lineman that he went to college, did the whole thing, was working in a corporate job, pushing paper around, didn't like it. Yep. And now he gets to use his hands, like create things. He's like, I'm like freaking out. I'm like, you're dealing with high voltage. He's like, it's awesome, right? I'm like, I'm scared of that. But like, he's actually doing something he loves and enjoys, contributing to the economy and making more money.
Go figure. Yeah. Well, I think for the longest time, and like this isn't like a political show, this isn't like a commentary show beyond real estate, typically Orlando, but I do think that we got so stuck in for so long with people like, hey, if I don't have a master's degree and go become X, Y, and Z, then my life wasn't worth anything. When they can go contribute in a really big way, like you said, get to use their hands, give to the economy and make really good money. So, but I digress. I feel like, going back to this, you've got this is an interesting thing because, unemployment is still essentially going down, which means that they're going to have to continue to raise interest rates in order to combat some of these great jobs numbers, which is kind of wild to think.
Yeah.
So somebody mentioned insurance. So this is a great question. We're going to wrap up on. A couple other people mentioned it as well. So what's happening with insurance? We'll be able to find some when we finally buy. Yes. So I had Brian from State Farm on just right after Hurricane Ian ended. Insurance companies are already starting to bind again. But I know, Greg, you see this on the lending side, last minute sort of to-dos, right? So how has the insurance been right now?
It's getting back this week. So there was a few that, last week, the FEMA disaster declared time was just wrapping up at the end of last week. So now we're back to, and I even have one right now that's a manufactured home, and it's got tie downs and straps and all that and whatever, and there was no damage. So they're binding it right now today. I think we should have the policy tomorrow. So it's back to full business. Now the thing that's going to be interesting is some of the companies that were here in the last few years that wrote policies. Are they going to be able to fulfill those policies, or are they going to go bankrupt and get out of the state? That's going to be interesting. But you're always going to have companies that are going to come back in and write policies, which we're seeing plenty do right now this week.
Yeah, agreed. I saw some number out there that Hurricane Ian's going to cost something like $11 billion for cleanup. There's a lot of insurance companies that are going to be shy, and I'm sure we're going to see some increase in general. But yeah, you're right. So there a lot of insurance companies that we're seeing are going out doing pre-closing inspections. So they bound the insurance 2 weeks ago, and they're like, wait a minute, we got to go back out and make sure there's still a roof, make sure there's still tie downs and all that kind of stuff. And so there's inspectors now specializing in these pre or post hurricane inspections, which is kind of smart on their part.
Yeah, for sure.
Yeah. Jeremy Knight, I love you too, man. He's checking in on vacation. I know this guy super well. Good times. Greg Matthews, Certified Mortgage Planners. What's the best way people can get a hold of you?
My cell phone number, it's 407-619-2488. And then you can check me out on Instagram at Greg Matthews Mortgages.
He's dropping all types of different tips on buying houses and mortgages and stuff like that. So definitely check him out. If you've stayed to the end watching this whole video, we so appreciate the opportunity to be your real estate resource of choice. If you're buying or selling in Central Florida, my team and I would love to help. Email us at info@posetgroup.com. We'll have more videos coming out here shortly, and we'll see you guys on the next video. Talk to you soon.